Ever looked at a stock chart and seen prices jumping all over the place? Or heard the news talk about market turbulence? That's volatility in action. It's a term thrown around a lot in the financial world, but what actually is it? And why should you, as an investor, or even someone just curious about the markets, care about it? Simply put, volatility measures how much the price of an asset like a stock, bond, or even cryptocurrency fluctuates over a given period. High volatility means the price swings dramatically, both up and down. Low volatility means the price stays relatively stable. It's essentially a measure of risk, but not in the way you might initially think. It's not about whether you'll lose money, but about how much you could potentially lose or gain in a short amount of time. Think of it like driving. A smooth, straight highway represents low volatility. You're moving forward consistently without many surprises. A winding mountain road, full of sharp turns and steep drops, represents high volatility. You're still getting to your destination, but the ride is much more unpredictable and potentially dangerous. Now, why is volatility relevant, especially for folks in the US? Well, the US stock market, while historically rewarding, isn't immune to volatility. We saw massive spikes in volatility during events like the 2008 financial crisis, the COVID-19 pandemic, and even more recently with concerns about inflation and interest rate hikes. These periods can be scary for investors, but understanding volatility can help you navigate them. It impacts your portfolio's returns and can create opportunities, but also risks if you're not prepared. Let's look at a couple of simple examples. Imagine two stocks, Stock A and Stock B. Over a year, both stocks end up increasing in value by 10%. Sounds great, right? But let's dig a little deeper. Stock A steadily increased throughout the year with minimal ups and downs. It was low volatility. Stock B, on the other hand, had a wild ride. It shot up 20% one month, plummeted 15% the next, and bounced around quite a bit. By year-end, it was up 10%, the same as Stock A, but the journey was drastically different. Stock B had higher volatility. While the final return was the same, the investor in Stock B experienced a lot more stress and uncertainty. They might have even panicked and sold at a loss during one of the dips. This illustrates a crucial point. Volatility isn't about losing money, it's about the degree of price fluctuation. How is volatility measured? One of the most common metrics is something called the VIX, or the CBOE Volatility Index. Think of the VIX as a fear gauge for the stock market. It measures the market's expectation of volatility over the next 30 days. A higher VIX indicates greater fear and uncertainty, and typically corresponds with a market downturn. A lower VIX suggests calmness and optimism. It's important to understand that volatility isn't inherently good or bad. It's just a characteristic of the market. High volatility can create opportunities for skilled traders and investors to profit from short-term price swings. However, it also increases the risk of losses. Low volatility might seem preferable, but it can also limit potential returns. Different assets have different levels of volatility. Generally, stocks are more volatile than bonds. Growth stocks, which are companies expected to grow rapidly, tend to be more volatile than value stocks, which are companies considered undervalued. Smaller companies are typically more volatile than larger, established companies. So how can you manage volatility in your portfolio? One strategy is diversification, spreading your investments across different asset classes, sectors, and geographic regions. This can help cushion the impact of any single investment's volatility. Another is dollar-cost averaging, investing a fixed amount of money at regular intervals, regardless of the market's price. This helps you buy more shares when prices are low and fewer shares when prices are high, reducing your overall risk. Finally, it's crucial to have a long-term perspective. Trying to time the market buying low and selling high is extremely difficult, even for professionals. Instead, focus on your long-term financial goals and stick to a well-thought-out investment plan. Don't panic sell during market downturns. Remember that volatility is a normal part of investing, and historically, the stock market has always recovered from downturns. Let's quickly summarize. Volatility is a measure of price fluctuations in the market. It's not inherently good or bad, but understanding it is crucial for managing risk and making informed investment decisions. Diversification, dollar-cost averaging, and a long-term perspective are all effective strategies for navigating volatility. The VIX is a common indicator used to gauge market expectations of volatility. And remember, different assets exhibit varying degrees of volatility. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.